Hi guys. So in this video, we'll be talking a bit about liquidity, all right? So I've been wanting to do this video for a long time, and I thought it's just now is the right time to drop this video, right? Because one of the basic foundational elements of the financial market is the concept of liquidity, all right? So in this video, we're talking about those basically three things, right? So we're going in depth. So this is basically what we're talking about. I think I should just lay that out for you guys to see. um Let me undo that. All right, so we're talking about basically four or three basic things. We'll be going kind of in depth. So this is we're talking about liquidity, right? Liquidity, right? So we're talking about the importance of liquidity, the types of liquidity, yeah, the definition. All right, so now some people have actually define liquidity in so many ways, right? Some people can identify liquidity in the charts, but they kind of get confused on how to apply this concept, right? So this video is going to answer the question of how exactly should liquidity be used, what should you be doing with the idea of liquidity, and how you can actually make this work for you. All right, so we're going to start on the basic first thing, which is what the definition of liquidity. All right, so I actually define liquidity in a very simple term. I define liquidity as where people would likely put their money, right? Where people like so that they define liquidity as, right? So where, right, traders would likely put in their money. This is also a different liquidity as, right? Where would traders likely put in their money? This is the most standard and basic definition of liquidity using smart money idea, the concept, right? So where traders would likely put in their money, right? So where would traders likely put in their sell orders, their sell stops? You know that if a trader is in a trade, right? His stop loss is actually where he's putting his money. Why? Because that is where if he is actually wrong, his money will be taken away from him, right? So that is where he's actually putting in his money, right? That your stop loss is actually where you put in your money, not really your entry. It's where you put in your stop loss. That's where you actually put in your entry, right? So those places that traders will likely consider as areas to get involved in the market or get involved in a trade. Okay, where will the trader likely get involved in the market? Right, that is what liquidity is. Those areas in which a trader will likely get involved, those patterns, those telltale signs are actually are used to lure traders to get into the market, right? So now the importance of understanding liquidity is because it's not something new that we have people that are called quote unquote the institutional traders, right? So these guys that are called the institutional traders, they are actually they target retail traders, all right? So they target retail traders in order to take the opposite side of their trades, right? You know that these guys are trading with huge orders, big lot sizes, big position sizes, right? Quote unquote, the smart money traders are actually the ones that are actually using this concept, right, in order to take money from the majority. That is why if you meet 100 traders, only about five are actually successful, right? And the rest are actually struggling because there is actually a kind of food chain, right? The smart money or the quote unquote institutional traders actually target what the smaller group of traders, right, to feed on them, right? So trading is basically taking money from one person and giving to another person, right? So that is why you must understand the concept of liquidity, right? That I know as some of you, for most of you watching this video, um, you guys must have been in situations in which you were actually right on a trade and the market actually takes you out before actually going in your favor, right? So that is why we have to understand this issue of liquidity, right? We have to understand how smart money views the market, and then we're able to leverage all the information, all right? So that takes us to the most important part of this lecture, which is what the types of liquidity, right? So I listed several types of liquidity and we'll be treating them one by one, all right? So we have basically about, there are so many of them, but for the sake of this call, I will not be going too far on each on the things I'm talking about. I also want to talk about the most basic ones and the ones you need, right? So these are the kind of liquidity which I actually use in my trading, right? And this is what most smart money traders use in their trading, right? So this is basically what they use, right? We have a few of them. We are just take a look at them. This is what we're talking about. We have the equal highs and lows. Some people call it double tops, double bottoms. We have the buy side liquidity and the sell side liquidity. We have internal liquidity. We have trend lines. We have old highs and all swing highs and lows. We have PDL, which is previous daily high, previous daily low, previous weekly high, previous weekly low, and Asian highs and lows, previous session highs and lows. These are what we call liquidity. All right. These are all kinds of liquidity. And I'm talking about them one by one, right? So we're also using chart examples as we progress. So let's start with the basic, with the very first one, right? So starting with this very one, right? Starting with yeah. All right. So yeah, when do that. All right. So now the first point, most of us when we came into the trading space, we are taught that when market comes to a support, you do what you sell. When markets come to resistance, sorry, when market comes to resistance, you sell, and when market comes to support, you buy. All right, that is what we are taught as trader traders. So if you see your chart now, what you likely do is that when you see this area as a support, you likely be doing what looking for sales. Why? Because you can see that what the market gave what you can see all these rejection patterns. You can see the market drove through, like blasted through it. All right, so this is what we call liquidity. Now, the reason why this liquidity is because there are people that will see this first touch, the second one, and then they anticipate that price will likely do what sell off this area once again. So you can see that the markets kind of trip them in, they would have likely taken this trade, put their stop loss a bit above this equal highs, and then they've done what? They've likely done taking a loss, right? So that is basically what this is about. Now, there are some people that would likely also see it as what is support. Why? Because the sub price do what? Bounce off this area, right? So you can see how the market came there. You can see this buy candle, this buy candle that kind of bought a bit. Then you can see it was slow. Some people have been seeing that, okay, this is actually a rejection pattern. And then what happened? Market slammed through. So this is what we call liquidity. There are areas in which people would likely want to get involved in the financial markets. Those areas that people likely to want to put in their money, that is what we call liquidity. All right. So I think I should take this off so we can just talk about them one by one. So now we have understood that. So equal highs and lows are areas of liquidity where the market would likely go for, where small money will likely trip in retail traders who are not informed. All right. So in my video which I made about, I talked about smart money key levels. Right. I talked about how to effectively use these support and resistance ideas. Right. So you can watch the video on. I made the topic is smart money key levels. Right. So I will talk about when to anticipate support and resistance playing out in your favor. Right now, the BSL and the SSL. Now, when it comes to buy side liquidity, BSL stands for buy side liquidity, while SSL stands for what? Sell side liquidity. So buy side liquidity is simply the liquidity to the upside. That means wherever people will likely be doing what? Trying to take their sell positions. The market is in a kind of um, um, resistance pattern, right? There are people that will likely do what be trying to do what to take their sells here, right? So this up area is also called buy side liquidity. Why? Because there are people that will likely put in their sell orders here, and then when the market trims them in, the market should take out their stop loss, then they're automatically was sold. Not when you're buying the market and your price hits your TP or SL, you have also done what you have sold, right? So the reason is what is called buy side liquidity because this is where you'll be forced to buy if the market should go against you. And also that those that believe in break and retest, so they'll likely put in their buy stops here. So when the market comes and trips them in, maybe they believe the market will break and then retest and then go higher. So also some people actually believe. So this becomes what an area where a lot of buy orders will be in, either in forms of stop losses or in some forms of buy stops, right? So those areas in which people will likely want to sell, right, are what we call buy side liquidity, right? And the reverse is for a buy. The people that want to buy what we call sell side liquidity because there are those that will buy and put their stop loss. So if you put your stop loss on a buy at this area, what happens is that if you trips your stop loss, then you have actually done what? You have sold. Right. And if you put a sell stop thinking that it will be a break and retest, what we have is what sell side liquidity. Right. So that's basically what those two things are. You have to learn how to identify them on the market. And it's very similar to equal highs and equal lows, right? Although it's not always the same, right? So buy side liquidity actually covers equal and equal loads. It covers internal liquidity. It covers a lot of all these things I'm talking about. So just learn how to see them, right? And the lesson is what we call internal liquidity. Internal liquidity is simply what a structure within a structure. So if you're in a bullish market and the market is giving you the higher highs and higher low, right? Sometimes you tend to see the market do something like this. Market is going to give a kind of sell structure inside of a bullish market. So this is what we call internal liquidity. And I believe that the markets are liquidity engineered, right? So the idea that market does this right, is that they are trying to trip in people to sell. And what happens is that when people see this kind of structure forming, they likely they want to think that the market might sell when overall the market was bullish. So this internal structure within a bullish market is also called internal liquidity, and the reverse is the case for a bearish market. So the market is bearish and you're not seeing a kind of bullish structure inside a bearish market. That's what we call internal liquidity, right? So you might see market do something like this. Market likely take out all these highs and then it happens. Or sometimes you might see it looking in this way. Maybe the market is bearish, and see market going selling downwards, right? You see a bearish market, and then you see a kind of bullish scenario, kind of double top scenario, double bottom scenario. Now, when the market does this, yes, the market is bearish, but you would think that this is all support, right? Because so what this touch, second touch, and then we likely do want to buy this. So when this happens, what happens that the market will likely do what? Take you out. So what happened here, the market did what? It's created what we call internal liquidity. So the market is bearish. Why should a bullish structure be forming in a bearish market? All right. So that was what we call internal liquidity. So internal liquidity will also come in form of inducement. That means the market can do something like this. Let me take this out. So the market could do something like this. You see the market do something like this. The market is bearish, all right, and then your POI is somewhere here. As you have your POI somewhere around there, right? Your POI is somewhere around here. You have your point of interest somewhere around there, and then the market does something like this. Instead of the market to hit to get to the POI, the market comes very close, and then it drops just before your POI. So what the market has done is it has done what we call an inducement. Why? Because some people will likely see this as an area to do what to go short, right? So they will see this as an opportunity to go short. This is the main supply zone, right? But the market dropped just before the supply zone. So it's what we call an inducement. It's under internal liquidity. The market has created what we call an inducement, only for price to do what? Only for price to do what? To run higher, take out this liquidity, and then do what? Go lower. So this is what we call internal liquidity. So inducements are form of accounts of what we call internal liquidity. They're what we call inducement. It happens a lot on the chart, right? So I might not be pointing each and every one of the charts for so this video will not be so long, right? But let me just quickly look for something like that. If I can see inducement on this market. Let me just quickly see if I can see something like an inducement on this particular market. All right. So you can see a kind of inducements here. What do we have here? We have this supply zone here. All right. Note what happened. Sorry. We have this supply zone here. See what happened. The market kind of came very close to it and then dropped. Why did the market go at once, right? The market came very close to the supply zone and then dropped. And look what happened finally. The market finally did what? It came and hit the supply zone perfectly here. And then what happened? The market was dropped, doing what? Taking out what? All these lows here. So this is just a typical example of what we call internal liquidity. The market was poised to go right, but it was actually a break of here. There was a kind of break of short-term lows here. So the market will come directly to the PY. It kind of dropped just before it, and then finally rally higher to the PY and then dropped and took out this low. So that's what we call internal liquidity. All right. So I hope that was clear. All right. So in some videos, I'll be giving more examples on all these things I talked about. Right. So let's talk about another one. Let's talk about another one. Let's talk about the next one here, which is the old swing highs and lows. Right. This is very, very okay. Trend lines. The trend lines comes when the market is, you know what trend lines are? The market is in a kind of dynamic movement, right? The market is giving some kind of trend lines. This is what we call the trend line liquidities. It happens everywhere on your chart, and it takes out. Look at this. So you can see a trend line liquidity right here. You can see this trend line forming, right? But what happened there? You can see how the market was giving a kind of trend line here, right? So what happened there? You can see the first touch, the second touch. What happened? The market slammed through the trend line. There was a drop lower. So you can see what they call trend line liquidity. Those areas are forming trend lines, right? The market forming trend lines, right? Inducing traders into the market. Look at this. Can you see this? So some people would have been likely to buy here because they saw what trend line, and then what happened? The market did what? It blasted through it. What we call internal what we call trend line liquidity, right? We also have what we call old swing highs and swing lows. So the market is how I define this is that if the market is bullish, right, and then you see, sorry, market is bearish, and then you see a break of structure, right? The market kind of takes out the last swing high. Automatically, all these old highs become what liquidity, because the market is poised to do what to go and take out old highs and lows, especially if there's what a change of structure in the market, right? So when you see something like this, why is this not going up? think I just take this all out. All right, so let me just do it down here. This is auto. So the market is trending downwards, and then you see the market give a kind of break on structure, right? So now what happens is that all these old highs become what liquidity, because the market will likely do what, because the people that will be hoping to sell this market at this point, they'll be like they'll be like supply zone, they will not mark another one and be like supply zone. It happens a lot of small traders, right? So this now becomes what internal liquidity. Sorry, old high. So this was like your old swing high. So the market would like to do what? Go for that. So this is only tantamount to what? A break of structure. So when you have a BOS, you cannot look to take what? Take out previous old highs and lows. So you're not trying to sell at old highs and lows once you see what? A break of structure. Because those areas become what? An area of what? Liquidity. All right. So you don't want to be taking trade as old swing highs and lows when the market has changed structure. All right. So that is how to use it. Then previous daily highs and lows are also areas of liquidity. So most times you will see the market take out. I think we should need to go to the day. Let me just let me copy this. Okay. Let's go to the daily time frame. Most times when the market is bullish, it tends to go for what? The previous daily high, right? So you can see how it happens. Just look at this. As the market was bullish, it kept taking out what? Previous daily high. You can see this, take out previous daily high. You can see this one, previous daily high. You can see this, PDH, previous daily high. So when the market is bullish, it tends to go for what? Previous daily highs. So these become areas of what? Liquidity. Right? You can see how the market has been bullish, has been doing what? Taking out previous daily highs, the highs of the previous days. And that is how the market is poised to operate, right? So you're looking at those areas as areas of what? Liquidity. Whenever you are looking for opportunities to take trades. So when you're bullish, you want to take out previous daily highs. And if you're bearish, you want to take out previous daily lows, right? And that also applies to previous weekly highs and lows. If you're bullish, your overall target should be what the previous weekly high. And if you're bearish, the overall target should be what the previous weekly low. So yeah, we also have Asian highs and lows. We'll combine it with what previous session highs and lows. So Asian liquidity is actually a concept I use a lot. So you can see that just simply come to your indicators. Asian liquidity forms between 8 o'clock to 12 o'clock New York time. So that window is when you usually find Asian liquidity form. So I kind of put an indicator to show you that. So you can see, look at this. You can see Asian high here. It's formed by 8 o'clock New York time. All right, sorry, 7 o'clock to what, 12 o'clock. So between 7 to 12 or 8 to 12, New York time, right? That is when you have Asian liquidity form. So Asian high and Asian low. So the market is really wants to be bearish. If you want to be bullish, market like to do was go for Asian lows first and then typically go for the Asian highs. You can see the market want to go higher, is wait for the Asian lows first and then what? Run for the Asian high. So when you're bullish, you want to see price drop below the Asian lows preferably and then do what? Go to take out what? The Asian high, right? So the highs and lows of the previous session, especially the Asian session, is usually an area of target. So if you want to buy a market, wait for the market to take out towards the Asian low before doing what, looking for your longs, because that is an area of liquidity. Because the London session typically takes out towards the previous session high and low before going was the original direction. So watch my video on power of three to understand this in more details. So my video talks about power of three. We explain this in brief, in more details, how this play out, why the market goes down before going higher. So you can watch my video on power of three to actually understand this video, right? So I think I've been able to explain all this. So you need to really backtest all of this. If you have a question, just type it in the comment section. I'm reading your comments and all of that, right? So I wish you guys the best. If you want to be part of our paid mentorship program where we go in depth, like I break all these concepts step by step, one by one, and that is available in the paid mentorship program, right? It costs just $58 for 1 year, and if you want to be part of us, just do it to send me a DM or use the link in the description, all right? So I see you guys in the next video. I hope this video was insightful. Do it to like, subscribe, and share with your friends, right? So see you guys in the next video, right? So goodbye.